All right, everybody. Welcome to Investment Education Academy's Wednesday discussion. So we're going to be talking about sectors today and why it's important to really be familiar with sectors when choosing stock. So with that being said, I also want to give some public service announcements. We have recently completed the new website, so you can go to ieanow.com. You can also go to investmenteducationacademy.com to see the new site. And Leon and I have been working on something in the realm of cryptocurrency. So announcement to come soon, but we're actually have just a pretty big announcement about what we're going to be doing in the cryptocurrency space. We look forward to you all learning about it, hopefully getting involved in what we're about to do. There'll probably be some limited spaces when it starts, but we have realized that this, number one, everyone knows the market's here to stay, but everybody's been thinking Bitcoin, Ethereum, Litecoin, Bitcoin Cash. Yeah, there's so much more. And when we say so much more, like 11,998 other coins out there. So it's just cracking the surface. So this is a good one to share. If you're listening to the podcast, we still thank you for listening to the podcast. We continue to be, we continue to grow. And with that being said, while I do housekeeping, Leon will tell you why we chose this topic today.
Yeah, so the topic today is sectors, right? And so Brent and I always say, when you're picking a stock, don't just look at the stock, right? Because so an example is if you have a what you consider to be you think is a strong stock in a weak sector, you actually notice if I've gone back into the research, you'll see that stock may climb some, but relative to stocks in other sectors, it doesn't climb anywhere near as much, right? So if you're in, say, like the last couple of years, the energy sector has been horrible. I think it's down like 40-50% over the last like 3 years. And if you've been investing in energy over that time, you've essentially lost money, right? Because you're in a sector or an industry that is going down, right? So while you may say, oh, ExxonMobil, Chevron, these are great companies, they pay good dividends, you've lost money the last 3 years. And you also notice that a lot of times companies will have decent earnings and decent sales, but the stock will still go down, right? And part of the reason for that reason is that their sector or industry is going down. So a stock can't fight against its own industry or sector, like it can't buck the trend. But if it does, it can only buck the trend only so much, right? So if the sector industry is down 20%, the stock may go up 3-4%. May go up maybe 5%, but you're not going to get like an outsized move just because the weight of that sector and that industry are drowning that stock. So this is why we always say it's very, very, very important. And everyone that's inside, that's an IEA member, knows, or if they don't, they should already know. We'll maybe bring this up later about what's called the top down methodology. And that's where when you start your research, you start with the sector, industry, then stock. Most people just start off with a stock, right? They'll just say, okay, you heard something from their friend, or they hear something on the news, and because it sounds good, or it looks good, or maybe they've done some research and they say, okay, this looks pretty good, let me get in. They buy it, and they wonder why, okay, the stock has pretty good fundamentals. Why is it still going down? Or why is it not really moving that much? Again, if you look a little deeper, you'll see that the sector and or industry are probably negative or really, really, really underperforming a lot of other sectors or industries. So that's why it's very, very, very important to always know the sector and or industry that you're investing in before you get into stock. The stock is actually the last thing you look at. Sector first, industry second, stock third.
Yeah, and also too, with that, when we look at stocks and we're wondering what is the behavior of the stock, and Leon and I talk about behavior of stocks a lot. You won't really truly understand the behavior of the stock if you don't know the sector. Because if you're looking at the overall market, the stock could be behaving erratically. And it could be, overvalued, valuations through the roof. And it looks horrible when compared to the general broad spectrum market. But when you look at the sector, it may be behaving completely normal. And if you don't know the sector, you won't know what to look for. And we do these lives, we have this conversation with you all because we have a lot of experience in this space and we know how to help you. We're not saying become, technical traders or understand every single thing, but these are baseline concepts that when you listen to these lives, you can implement tomorrow. There are a lot of people out here who, they're gurus and they want you to follow their picks, sign up. We do have a membership platform but the information that we give is executable. Executable, is that the right word?
It's cute. I think it's cute. Yeah.
Yeah, executable like today. So in this space, we want you to use it. It's not just like sign up for Invest in Education Academy, sign up for Invest in Education Academy. It's not. Use the information, make your life better, share it with a friend. If you want to join. But keep tuning in every Wednesday, because these are questions that we get asked a lot. Like, honestly, this is our Q&A. And then really it's our FAQs. So many people have asked us these questions. And when we give you the answers, what will you do with the information? So we really hope that you're using the information we give. We hope that you're sharing it with a friend, have a discussion later on, turn off the TV. I'm getting texts now, working on it. So, share it with somebody, but have the discussion later on, like, how are you applying it? And how could we both utilize it to move forward in our life? Because savings accounts are not where it's at.
Nope, not at all. Not at all.
Let me pull up the first slide.
Yeah, pull the slide. So, and with the slide, so cool thing about the slide is it's going to show why we say. Could you make it a little bigger, Brent?
Yeah,
it'd be good. So this slide is going to show why we say sectors and or industries are important, and that you're going. Whoa, we're going wrong. That's about good. Yeah. I mean that should be good. Okay, so what we have on the screen here is a what's called a percent change chart, and it's just showing, and it's covering three sectors. It's covering the solar industry, the semiconductor industry, and then the consumer discretionary industry. The reason we have these three on the screen is because these are the three top industries over the last 3 years, right? So top of the screen, you see the solar industry. Over the last 3 years, the solar industry is up 270% on average the last 3 years. The semiconductor industry is second at up 180% over the last 3 years. And consumer discretionary industry is up 60% over the last 3 years.
Leon, real quick. So for anybody who is a IEA member listening to this, you will know from the hot seat Saturday that we've had our last hot seat. How long has she been investing? Was it 4? Was it?
Who was it? Lynette was the last one, I believe.
I believe it was Lynette. It was 4 months. Has she been investing, or 7 months?
Yeah. Well. So Diane was the one who been investing with about 4 months.
4 months.
She was up 60-some odd percent.
Okay, so Lynette had been with us for about 7 months, and she had stocks in this sector that were up on average like 37%.
No. It was solar. They were up no less than 44%.
No, I think her lowest solar was 34.
She had 2 solar, and they were
3.
both, because I remember I keyed in that because I was like, "Oh, you got solar."
I think she was 3. It was 2 on the first page, 1 on the third page.
Okay, but they were up. So let's say average 30, mid-30s to 40%.
Yeah. And in that space, I'm just really, the point is this: if you were an IEA member, you would have known when we were really bullish on solar, like as a sector. And in that moment, if you would have invested, you're just in that area alone. Well, you know what? In that area alone for hot seat, we have an investor we know is somewhere between 37 and 42% rate of return in this sector. But I'll even go out and say Leon picked like 1 or 2 or 3 or 4 or so of these companies like early on last year. And I want to say the highest one is over 100% rate of return, right?
Yeah, it was First Solar, and it was up. I think at the height it was up over like 110%. I think it's come down some with the market, pull back some. But yeah, it was up over well over 100%. So
when you say pull back, tell me, just for people listening who are like, oh, so it pulled back. What did it pull back to?
Yeah, so it was up, I believe it was up 110%. I think now it's up like 90, 95%. So it's pulled back like.
I think that's important to say, because people hear, oh, it's a pullback, and they're like, see, I knew it was a pullback. I knew it. I told you. And then all of a sudden you're like, yeah, pull back to 90%. That means that you're still getting 90% rate of return from that particular investment. Now we're going to go through the sector as a whole, and you will understand why this sector is so important. There's some other sectors very important today, but we're talking about solar. And I really just want people to understand, you're talking about a pullback of a stock Leon picked. that is now at 90% rate of return. And that's
And,
down.
and that's after losing 20%.
So, I mean, for anybody who doesn't understand what that means, really, like if he were investing that money, I mean, if that was a solo investment and it was just growing, his money would be doubling roughly every 8 months, 9 months. And so if he had 100,000 in 9 months, it'd be 200,000. 9 months from then, it would be 400,000. 9 months from then, it would be 800,000. So we're talking about within a 7-year period. I mean, granted, it won't continue to run this way, but just to give you just a concept so you can put some numbers to it, we're talking about like an 8-year run over $1 million from 100,000. If you have that money in a savings account, you'll die before that ever happens.
Yeah.
I mean, it's the best way to say it. So
yeah,
we really hope you're listening. And if you have questions, please post them. We'd be happy to answer. But go ahead, Leon.
Yeah. So with this, so one thing I want people to realize, and this is kind of like so all of us, we're what Wall Street calls retail investors, right? Like we're just average people, average investors, versus Wall Street and institutions. Well, one thing that we retail investors don't typically get is gains or losses are relative, right? They're not in a vacuum. So when you look at here and say, okay, consumer discretionary was up 60% in 3 years, that sounds great, right? Sounds wonderful. I mean, who wouldn't want 60% return in 3 years when, again, a savings account, you're getting 0.05. But that's relative to other sectors or industries, right? So if you look at consumer discretionary relative to solar, that's a huge difference, right? Well, actually, I'm gonna make the point of here. So on left side, let me before I go to you. On left side of this chart, I have difference in magnitude, right? So that was kind of the point I'm making. So semiconductors versus solar. So semiconductors returned in 3 years 180%, while solar returned 270%. Both of those are great returns. However, investing in semiconductors versus investing in solar, you would have cost yourself 90% less return. So not that you would have lost money, but you would have earned 90% more on your money had you invested in solar versus semiconductor. This is what I'm saying about relative returns and relative losses. Again, 180% is great, but relative to solar, it's not so great, right? But again, if you have this information and know that solar is absolutely killing it the last 3 to 5 years, you want to put a lot, not saying all, but a lot of your investment money towards solar, because that is a hugely growing industry. So semiconductors versus solar, you would have earned 90% more on your money investing in solar. Now doing consumer discretionary versus semiconductors, the difference is 120%. So had you invested in semi over consumer discretionary, you would have made 120% more on your money. Again, consumer discretionary, 60% gain is great, but relative to the semiconductor industry, it's not so great because you're looking at 120% difference, 120% less you would have returned on your money with consumer discretionary versus semiconductor. And then finally, the big daddy, consumer discretionary versus solar. You're talking about a 210% difference. You would have made 210% more on your money had you invested in solar versus investing in consumer discretionary. So this is why we say it's very, very, I think it's the most important thing in investing is knowing the sector and or industries that are leading the market higher, and then worrying about the stock later. The stock will work itself out as long as you're in a strong sector or industry. But I just hate the fact that most of us, we just dive right into the stock, pick a stock because friend told us, saw it on TV, Kramer talked about it, what have you. Maybe do a little research. We say, okay, it looks good. We get into it, and then we see, okay, we only made 10%. When you turn around and look at something like for solar, that was up 100% in like 4 months. And the reason it was because it's in such an industry that's on fire, being the solar industry. So I say that to say returns, think of returns as relative and not absolute. Yeah, you got 60% consumer discretionary, but how does that work? How does that look against relative to solar, semiconductors, tech, what have you? So that's why it's really, really important to know industries and sector returns before picking the stock.
And for anybody who's looking at this thinking, oh, okay, cool. So you mean I just go to solar and pick a stock and I'm good? No, that's not what it means. You still have to pay attention to the company. You still have to make sure that, number one, it's a fundamentally sound company. Like, what do the financials say about it? What does management look like? how long has it been in the industry, what is his growth plan. These are things you should know, but there's also publicly available information. Just don't think, okay, well, now I'm gonna go to solar, so I'm gonna day trade in solar because they said it was hot and I can win. So we want to just give you some framework around what we're saying. You definitely, the sector is huge, but you have to pay attention to the actual companies that you're buying, because an insolvent company is not going to do you any favors. And
right, yeah, I mean, yeah, I mean, yeah, you still got to do your research, right? I mean, I don't care what sector, industry, whatever it is, still got to do research, because in the solar industry, in the solar sector and industry, there are still bad companies, right? There are companies that are losing money. There are companies that aren't performing. It doesn't mean everything is great. This is just showing you the return of the sector of all the companies in there, but you still got to know which ones are the leading ones and which ones are the bad ones. But again, but still do that research on those sectors and industries to know which ones are leading the market, because think about it, that puts a wind at your back, right? If you're in a sector or industry that's returned 270% over the last 3 years versus something like energy that's down 60%, where are you most likely to win? Probabilities say where you most likely to win, right? I mean, by far and away, it's going to be in the solar industry or sector. So it just puts the wind at your back knowing which sectors and industries are leading the market higher.
And for those of you all thinking, okay, I get it, but I need to go deeper in this. We've had posts saying, I missed this inside of the platform. We will tag some people in some of our posts. So we see the missed it comments, and we will tag you inside the platform. We got you covered. And then for those who are thinking, I would love to have more conversation about this, we are going over to Clubhouse after this is over to have our Clubhouse discussion. You can find it. We're doing IEA discussing stocks. What is it? Stop crypto and everything money.
Yeah. Yep.
And so, and also you can just look for Leon Noble or Brent Simpson. And, to kind of put a bow on this all, this market in this segment is really important, but it's also really important to be plugged into communities that understand maybe when it's not so relevant anymore. And also what stocks in it, like Leon mentioned Kramer. If anybody was solely picking stocks based off of what Kramer was saying.
Well, tell about who Kramer is.
Yeah, Jim Kramer from Cutlow Kramer, CNBC.
No. Mad Money now.
Mad Money. He's an analyst, a stock analyst. He's been like he has the Kramer effect on the market. Like he can say things to literally like move the market. And we say always do your research, Leon. I always say always do your research, always do your research. Leon and I probably have been watching Kramer for over 15 years.
Yeah.
and I was at Bowie State University, like listening to CNBC, and people thought it was crazy. But that's what I liked. But recently he picked Workhorse as like one of the companies that were going to take off and run, because the sector was hot. EV, everything, things is hot. And anybody who, again, is in our ecosystem knows that Workhorse took a very strong L and took a loss on a contract that would have accounted for 90% of their profits. And if you know this, then you know not to pick it, because even if they win, it's really like gambling. And you really don't want to do it. And the one thing we can tell you all about investing that's going to ring true for whoever, everybody watching this is going to ring true for whoever you are. You will always have regrets. You're going to regret not getting in earlier. You're going to regret not putting in more money. You're going to regret not taking your money out sooner. You're going to regret buying it in the first place. You're going to regret never being in the market. You're going to fall on one end of that spectrum, and it's going to hurt. So just get used to it, understand the market. That's what we say, understanding sectors is really important, because once you get used to the behavior of certain sectors, they don't all behave the same. Like no kid is all the same as every other kid in the world. Sectors are no different. They have their own personalities. So for those of you all who want to continue the conversation with us, we are going over to Clubhouse. You can look for IEA discussion. It's going to be something around stocks, crypto, and everything money. But you can also look for Leon Noble or Brent Simpson. We also would love for you to look at the new website. You can go to www.ieanow.com, or you can go to the old faithful www.investingeducationacademy.com and tell us what you think. Come back and give us some feedback. We're still a work in progress. It's phase one, so several phases to come, but it's functional, and we simplified it because we wanted to make it simple for you all. And am I missing anything, Leon? Stock picks.
Yeah. Just last point on this is that I just really want everybody to. I really want to drill this home. Think of the stock as the last thing you pick. You always want to go sector, industry, stock. And I know it's not always the easiest thing to find this information. That's something we're trying to really provide more of inside IEA, is to bring this, to kind of distill all this down. But it's just really, really important, because again, if you buy a strong stock in a bad sector, you're not going to see the really good returns. You can buy a bad stock in a good sector and see outsized returns relative to the market, because that entire sector is moving. So and they also know that returns and losses are relative. 60% return looks great, but it's nothing compared to what solar's done at 270. So yeah, I just want to make those points.
Yeah, and while Leon's saying that, I just want to laugh out loud. I mean, we're really having a conversation saying 60 is not a good rate return.
Right.
But this, I mean, when you get into the market, this is real talk. Like, 60% isn't unusual. It's not guaranteed, it's not every day, but it's also not unusual. And as much as possible for everybody who's watching this and still keeps their savings, like their entire savings in a savings account, you are losing. Your money is not working for you. You are a bad employer. Like, you have to get your money to work efficiently and not just lay there dormant inside of a savings account. You're not making anything. And when, I'm saying we're joking about a 60% rate of return, but, one of my clients came to visit me today, and I know, their portfolio is returning over 200% rate of return in the last 18 months. And it made a difference. It made a huge difference. So just please get away from those savings accounts. Okay. So we owe you all 2 stock picks. I will start. I chose GE. I'm gonna be honest with you all. I chose it because it was easy and I needed my pick. So it would have been my first choice, but I had a lot going on, so I went with the easy choice. GE, their dividend is almost non-existent at this point. Is less than 1%. So they're still beating the savings account. Let me start there. Still beating a savings account, but it's not a great dividend, but the company is strong. And the reason I actually like them is they're at the bottom. And that may sound funny, but they're at a place now where they can be the comeback kid, but they have to do some repositioning of the company overall. And as we move to these renewable energy sources, they have to determine who they're going to be in the industry. But when you work or you have a GE, you actually have the capital to do acquisitions that you need to get the company changed quick, very fast. Also, you have the connections in the industry to get regulation pushed forward, to get anything changed in the company, again, that you need. And it may seem odd that we're talking about regulation in a company. There are a lot of regulations that companies, large corporations, need to get through in order to get goals accomplished. And when you have deep and long-running connects, it really does help. It's social capital. So you don't want to discount social capital with a company like this. Although they still have $119 billion market cap, their 52-week high is like roughly $14, which isn't much from where they are now. But I think over the next 5 years, you're going to see GE. Actually, Leon and I just said it, and Leon really said it. Over the next 5 years, GE can be in a good place. If you buy this company, it will be a long hold. I wouldn't run to it necessarily, but I may take a small position in just because it's at the bottom. And I've seen companies like this when they get to a low position, and then all of a sudden they figure it out. And them figuring it out could happen relatively easily.
The 52-week low is 548, so it's a double from its low. And G is a turnaround story, right? Like G used to be, the 800-pound gorilla in the industrial space, and they've fallen on hard times the last 3 to 5 years. So they're a turnaround story. I mean, the stock basically bottomed at 5 and it's doubled since then. So yeah, I think it's a good bet. They just recently sold off their jet engine business, I believe. So they're getting rid of a lot of assets that are kind of dragging them down because they had a lot of debt. So GE it's a turnaround play. So if you got, like Brent said, if you have a long-term horizon, GE's a good bet.
Yeah. Also, too, GE had, just for the notes, I want to say this is from memory, so I'm not 100% sure, but I think it's like 52% rate of return over the last 2 years. They were down significantly. And this part, I'm give or take on it, like 50-50. They're thinking about doing an 8-for-1 reverse stock split. What that does is it doesn't change the market cap, but it actually allows them to reacquire more voting shares, which allows them to get things done quicker. Normally, a company doing that big of a reverse stock split is an indicator that something's drastically wrong. In my book, that's the way I see it. But in GE's, I think it's just they want to reposition and they want to increase their price per share to have a stronger position, which will increase their price per share. It won't change the T in China for those who are thinking, oh, well, that means that if they do a reverse stock split, it benefits me in some big. No, it's just like a stock split. It doesn't change your actual position. It just means that you have more or less of the stock. In this case, less. So I do think it's interesting they're doing a reverse stock split for a company that size that isn't going into bankruptcy. That's abnormal. So,
well, I don't know if I know they announced it. I don't know if they're actually doing it. I think
that's why I say it's discussion.
Discussion, yeah. I think the board is still talking about it. Yep. Mm.
All right, what's your pick, Lee?
All right, so my pick is a company called Illumina. Ticker symbol is ILMN.
Yep.
Yeah, Illumina. So they make medical devices around genetic research, genetic sequencing, and cancer. Their customers are biopharma companies, consumer genomics companies, and primary care practices. They have a massive 17,000. So in this space of genetic sequencing, they're like the Microsoft, right? They're the king of the hill. They have an install base of 17,000 machines around the world. But what's interesting about the machines, though, which makes it this kind of cool, is that, so just to make sure I use the right terminology. So each machine has to use what's called a compatible sequencing kit, right? So when somebody buys this machine, they do it, do all the business, but they need this compatible sequencing kit to work this machine. Those run out, right? They're whatever in these kits, they eventually run out. So anybody who buys a machine has to order more kits. And so what this does is every time they sell one, they're also bring on recurring revenue, because you sell a machine for how much a machine costs, but then whoever buys it is gonna have to come back to you time and time again to get these sequencing kits. So each machine, while it's great for sale, it also brings in recurring revenue as well. So I thought that was really interesting. As far as, like I said, and they are the Microsoft of this industry. They are the big boy. And they're down. I can't remember the percentage, but they're down a lot off their recent high. They were running hard for a minute, but as the market pulled back recently, they dropped some. So I jumped in it as much as I could. So the 3-year average revenue growth is 6.27%, and their 3-year average profit growth is 0. But only reason it's 0 is because of 2020 in COVID. That like everybody else, they took a hit in revenue and and sales because of COVID. But when you go back to the prior 3 years, 2017 through 2019, their average profit growth was 30%. So excluding COVID, excluding that anomalous year, they're growing profits at 30% and growing revenues at 6.27%. So solid growth. Those profits, again, like I always say, a company that's growing profits over 20% is considered "quote unquote" a growth company, and they're doing it at 30% over the last 3 years. So and they're like the number 1 position company in the space of gene sequencing and cancer. So that is Illumina, ticker symbol ILMN.
Yeah, and this is actually a great company when you're talking about fractional shares. For anybody who's like, oh, I love to get in, but it's $420 a share. I don't know about that. This is that moment where we're in an environment, first time in history, it doesn't matter. You can get fractional, first time ever. So this is that moment. Like, are you going to stay? The reasons for being scared of the market kind of don't exist, unless you just say you just don't want to do it. But if you're looking at this and you're thinking, oh, but it's 420, it's close to its highs. Well, not close, but its highs reach. It says $555 a share. You get in at 420, you don't have to buy the entire share. You can put $100 in. You can put $75 in. You can put 50 in. You can put 300. You can put 200. Just know you don't have to buy the entire share. There are fractional shares out there. We are trying to not only give you information, we're giving you the strategy on how you can get in the game. So with that being said, if you do still feel like, you know what, I need more information, feel free. We invite anyone who wants to join Investing Education Academy. You can go to ieanow.com, join. We're happy to have you. We're growing, and this stuff it's not inherently known to everybody. So you really do have to get into a tribe where this is normal conversation and you're learning things that otherwise you wouldn't have learned, and you're surrounded by people who believe in the same thing you believe in. Because if you're trying to get into this world of investing, especially stock investing, but none of your natural market does it, it's hard to do. It's a mindset thing. So, and for those of you all who are, we've been in the market for years and you're experienced investors, you should join IEA because we have a number of experienced investors. Leon and I still are finding out new things from our members that we're sure any new or seasoned investor also would definitely take some notes away from some of our meetings with new information to grow their portfolios. So with that being said, we're heading over to Clubhouse now. We look forward to seeing you all there. You can look for Leon Noble, Brent Simpson, or IEA, crypto, money, stocks, I don't know. Just look for IEA.
Yeah, or just look for me or Brent. Yeah.
So thank you for being with us. Thank you for listening to the podcast. Thank you for being part of our tribe. Also, anybody on here can go to the Facebook group. If you just go to Facebook and search Investing Education Academy, you'll find our group, and there's a lot of good information there as well. So we look forward to bringing you into the ecosystem wherever you feel most comfortable. Have a great day, and thank you for being with us.